Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. So let me just remind you, now that I think probably most of you are on, it's a couple minutes after 2, or excuse me, 10, that you are recording. We're recording this. You are muted. You do have an option for question and answer. However, chat should be disabled. And let's get started. So again, lots coming up. There's a lot of news out there, but I'm going to focus on a couple different areas. First of all, we talked on the 14th of September, the last time we were together, about the Consumer Price Index. So we had the report from the Bureau of Labor Statistics. We had the number on that day, and the percentage change from August 2020, right? So it's a month behind. From August 2020 until August 2021 was 5.3%. So the headlines caught up to that in the 2 weeks we've been gone. You've been hearing about the highest inflation in 30 years, and what does this mean? And there's a lot of concern out there, as rightfully so. Of course, the question is, we're comparing this to very, very low inflation, low demand last year. Now we have a situation with very high demand and very low supply. So of course, that's going to drive up costs. And we're seeing that nearly across the board, and everything I seem to touch. Even my barbecue is getting more expensive. So, and things are difficult to obtain. So that makes it more challenging as well. Everything seems to be on a waiting list, and that'll teach us patience, I guess. And we're so used to everything being delivered in a couple of days on Amazon that maybe we could all use a little patience. But I'll get off of that for a moment. So big changes proposed, and I used the word. Let me go back to CPI, Consumer Price Index, and that's inflation. So you're going to hear a lot of headlines over the next couple of weeks, but here's the schedule. On October 13th, we get from the Bureau of Labor Statistics the Consumer Price Index report. So that comes out at 8:30. So I'll have that for you the following Tuesday. That's a Wednesday. I'll have that for you the following Tuesday. We also see the Producer Price Index on the 14th. So we could talk a bit about that also on the following Tuesday. And this is something certainly to pay attention to. We're in an environment of very low interest rates and very high inflation. And that can be very challenging when you're investing for retirement, which most of you folks are. You're either right on the cusp of it or you're deep into it. Many of you are starting the retirement. So you may have heard of these new tax proposals coming out from the House Ways and Means Committee. And you may have heard about the impact on Roth conversions and Roth IRAs. So I want to talk about it a little bit. And I want to remind you, though, that this is simply a proposal and means nothing other than it gives us an idea of how Congress is thinking. So I have a really great post that was written by Sarah Brenner from the Slot Group. And again, this is Ed Slot's lead advisor group. I happen to be part of the master lead advisor group. And, we get so much good information from them. So this was just published yesterday. There's some other material out there as well that came from one previous member of the Slot Group, but Jeff Levine, who does a great job. He used to be one of the analysts for Slot, and he went out and started his own investment firm. But I still follow him, and he does a great job as well. But let me read to you what Sarah writes. Regarding after-tax conversion, so you have two ways to put money into a Roth IRA. That's contributions and conversions. Converting funds to a Roth IRA is simply taking it from the status it's in, typically tax deferred, to the Roth IRA, which is tax advantaged or tax free. So that's a conversion. So taking it from that one type of account, right? We refer to them as buckets, and moving it to a Roth, and that's called a conversion. Now you have pre-tax conversions and after-tax conversions. So an after-tax conversion would be that you've already paid tax on that money, and some plans allow you to do that. Some retirement plans allow you to do that. So you're already paid tax on that money, but you put it in your plan, and then you can convert it to a Roth IRA. That is known as a mega backdoor Roth IRA or a backdoor Roth IRA contribution. And it's been a key strategy for many years for folks who are higher income earners. Now, if you have questions about what that means to be a higher income regarding Roth IRAs, I'm just going to remind you, and I'll share with you that you can go to our website. We're always working on improving this website. And I mean, always. It is really a constant thing that we work on. So I'm going to share my screen with you quickly. I'm going to take you to my website. And if you don't already know, you can go to this section here that reads, can everyone see my website, Attleboro Wealth Management? Raise your hand. Thank you very much. So you would go into this slot corner, and I put these in the Ed slot corner because these are charts that Ed produces. And I want everybody to be very clear about this. So these are charts you can download. 2021 tax planning. I know I've gone through this before, but I think repetition is good. Medicare income planning. And here's your retirement plan contribution limits. So we're going to be talking a little bit about this today, because what they're talking about doing is stop applying these phase out limits to conversions and not just contributions. So you can see what currently these phase out limits are, and but this does not apply to conversions. The new proposed legislation, or what came out of the House Ways and Means Committee, will also now apply to conversions. And I'll talk more about that for a moment, or in a moment. So let me stop my share or my notes. So anyway, let me just remind you. I'm sorry, I'm jumping around a little bit. I'm going to go back to my website. So if you want this, for example, you can click this download now button. All you have to do is put in your email. That just lets me know who's downloading the forms. And you're already on our contact list. Some people find this organically, and that gives me information about who's downloading the forms. So we're not going to do anything with that information. So you hit download now, and you can have access to all these forms. Okay, so let me stop share again. I have to find my notes again. Okay, so that's the backdoor Roth IRA and the mega backdoor Roth IRA regarding after-tax conversions. The current proposal would absolutely end this strategy. It would also shut down the strategies of funding an employer plan. I'm reading this from Sarah now, with after-tax dollars and converting them to a Roth IRA or converting them to a Roth account within the plan. These types of conversions will be outlawed beginning next year. This would apply to everybody regardless of income. So this is a really important tool for people. So if you earn too much money, right, regarding the phase outs, and you have it structured correctly, a lot of people are doing backdoor Roth IRA contributions. So that is, you make a non-deductible contribution to a traditional IRA, and you immediately convert it to a Roth IRA. That's called a backdoor Roth IRA contribution. The mega backdoor Roth IRA contribution is when you put money into a retirement plan, can be to the tune of $50-some thousand, and you can convert it to a Roth IRA, the after-tax contributions. Well, this will completely shut that down. And what's interesting about this is that the IRS has validated this strategy for many, many years now. So it's really turning the tide on what the IRS has been saying, but that's what Congress can do. Now, what about pre-tax conversions? Pre-tax is when you contribute money into either a Roth IRA, or a traditional IRA, or a traditional 401k, or traditional retirement plan. And then at some point you convert that to a Roth, either 401k or IRA. Well, now this proposal says the ability to convert pre-tax dollars would be eliminated for taxpayers with income over $400,000 if single, and over $450,000 is if married. Excuse me. So let me repeat that. The ability to convert pre-tax dollars would be eliminated for taxpayers with income over $400,000 if single, and over $450,000 if married. So this is important. We work with a lot of thresholds. Often we're trying to stay below a certain tax bracket, marginal tax rate, or a dollar tax rate for people, and we push those income levels, this is going to add another level of complexity to that. Sometimes we're trying to stay below IRMA, the income related monthly adjustment amounts for Medicare. There's a lot of different things that we're always checking with these Roth conversions and calculating to make sure that clients understand the tax and the cost of every conversion, because it's not just tax, there's also other costs potentially for conversions. So that's, if you make over $400,000, if you're single, $450,000, if you're married, under this proposal, you cannot do a Roth conversion. Now, we used to have this, we used to have income limitations, I guess prior to 2010. That changed, and they erased those income limitations for Roth conversions. So Sarah writes, Congress is looking to return to the bad old days and bring it back. The good news in this is it's not for 10 years. So this proposal doesn't take place, or it doesn't, the proposal, if it becomes law, this change wouldn't take place until 2031. So that gives us plenty of time to plan and to get these things done. So you should, if you're active in your retirement right now, and we're in a strategy right now, or you're starting to put together your strategy right now, you should have a bit of a sigh of relief there. Now, again, these are just proposals, and nothing has been voted on. Nothing really has been presented to Congress as a whole, and certainly nothing has been signed by the president. So it's certainly, got a really good chance of changing between now and the time it becomes law. But you should know how Congress is thinking. So there's two things about the delay to 2031. First of all, the federal government gets an awful lot of money on because of Roth conversions, and it's becoming more popular. So you may know this already just from what you see, but back in 2011, yes. So about this time in 2011, this time of year, I attended that Ed Slott continuing education program in Newark, New Jersey. And everything changed for me. As you've heard me say, I learned all about, I knew about Roth conversions. I knew about the tax benefit of life insurance, but I knew this much about it. Now, I was a brand new CFP. You've heard this story, but I kind of learned what I didn't know. And I headed down this journey of developing tax efficient strategies for my clients. And it's changed everything. And it really is the way to operate, in my opinion. More and more people have jumped on that train, and that's a good thing. I just noticed that there's a new Ed Slott advisor in the Newtown area where we're home based, and that's a good thing. I don't worry about competition that way, right? Because first of all, there's awful lot of people that need help. And I think we're very specialized in what we do from tax planning and investment management. And if anything, we have to pump brakes on accepting new clients throughout the year in the past couple of years for sure. So I'm glad to see more people, again, jumping on the train to this philosophy, because it's vitally important to you folks. So I'm starting to see more classes about tax efficiency out there, and I'm starting to see more people. And I hope this Ed Slott group grows from 400 to 800 to 4,000. And there's thousands of advisors who are doing the right thing for you folks who are retiring, because there's a lot of you baby boomers out there who are retiring. So I'm not as worried about you, right? I know the folks listening to this, you already have that mentality. Many of you are all already on the path, but geez, I do worry about your kids and grandkids and my kids and grandkids, because suddenly if 10 years goes by and now your kids, your grandkids are starting to save money, and they follow that old paradigm that we were all taught, because it's still out there. It's still the most prevalent thought out there, is to fund tax deferred strategies. They're going to be in a position possibly where they can't do what you're doing, and that's doing Roth conversions. So this is a really great time to talk to your kids about properly saving in the right buckets. If you're a client of mine, client of ours, you always have the opportunity to have us have a discussion with your loved ones, people close to you, your children. It's all part of the deal. We keep things very, very small in our group and with our clients, so that we can have these help as many people as we can through the relationships we have with you, in our group. So if you're, I've had many conversations with children of clients, grandchildren of clients, about how to properly save and invest their funds. And I'm happy to do that for you as well, because you can see the path is going to be that, we've eliminated stretch IRAs. That was done a couple of years ago. We're eliminating backdoor Roth. I think that's probably going to stick in this plan. We're eliminating that. Now we're putting caps on not just contributions, but now conversions. And it goes further than that. So that's a lot of the discussion in Sarah's letter. I'll just end with her finishing paragraph. She says it's smart to recognize that Roth conversions are on Congress's radar. If you have been on the fence about converting to a Roth, 2021 may be your year. For backdoor Roth conversions, it may be your last chance. For pre-tax conversions, the time might be right too. Congress is taking aim at the tax code, and current rates and rules may not be around for long. Really, absolutely true. Now, that's kind of just the tip of the iceberg. If we go on to a deeper look at it, and I'll just give you the reference here. The proposed Roth legislation update is a draft version of subtitle 1 of the Democrats' proposed tax legislation. This falls under section 138311, 138311, if you're a technical type of person and you want to look at it. So Jeff Levine he now writes for a publication called Horse's Mouth, and Jeff used to be one of the main strategists at the Ed Slott Group. I got to know Jeff quite a bit over the years, and he does a great job. Very good analyst. He's a CPA and a CFP. So it's not just about what I talked about with the income limitations for Roth conversions, but it's also the amount that you have in certain accounts. So here's another section. Anyone with income in excess, Jeff writes, anyone with income in excess of the thresholds noted above for contributions and $10 million to $20 million in retirement accounts will be required to distribute 50% of the excess over $10 million. So not only are they putting limits on the amount of income you can have, now they're talking about putting limits on the amount of money that you can have in your retirement accounts. These are really IRAs. Let's be clear about that. From what I'm understanding from this publication, we're talking about IRAs, not necessarily the IRAs. And so when I say IRAs, I mean traditional IRAs and Roth IRAs, but not 401ks and other retirement plans, pension plans, etc. So if you have $17 million in retirement accounts, in this example, you have a $3.5 million RMD. So if you anything that's 50% of the excess over $10 million. So this gets very, very complicated. So it's difficult to save or to end up with 10 million, $15 million in an IRA by itself, because the contribution levels are small throughout your lifetime. You can certainly have $1 million, $2 million. Where they become larger is when you transfer 401ks. So if you've got $1 million IRA, you got a couple $1 million 401k, and you transfer those together. Well, now you have a $3 million IRA, and you invested appropriately over time, and that could certainly grow to 10, 12, $20 million. We have account sizes that we project out for clients that are large sizes. So there's going to be a lot of planning discussions to be had. And what I'm reading from this is that as challenging as Roth conversions are now, and it's a very, very important tool. It's the most important tool I believe we have in tax efficient planning. Life insurance is very important as well, but the Roth IRA is the most important tool in Roth conversions. I can't tell you how many people I've had over the years who take a class from us and then say, well, I understand it, I'm going to do this on my own, and then come back a year or two later and say, I could not do that on my own. We need your help, and we are expert at this. So, we're here to help. It's what we do. This is going to be even more challenging for individuals to navigate these potential pitfalls, because it's not about what you do today. Most people can plan appropriately for 2021, 2022, whether it's Roth conversions, income, tax. Maybe people get caught up in triggers that they didn't realize that could occur with tax and other costs and Roth conversion. So that's a year-to-year process. But where people fall down is they miss out on the planning. So you see people develop their own spreadsheets or use something they find online, and while they're fine, they're typically not accurate or not robust enough. And in fact, I'm working on writing a program, an online program, at the urging of my son, who does the same thing, but in the music business, right? He writes these programs quite successfully. One of the problems I'm having is finding a good platform for people to input their financial planning information. Because if we're, putting programs out there, we can't do financial planning for every person who purchases a program. So there's just nothing that I've been able to find. If you know of something, let me know. But there's nothing that I've been able to find that's robust enough where we can put our endorsement on it for financial planning. So if you think that a $10 million, $20 million IRA limitation isn't going to apply to you, you might want to think again, because it certainly can. And that's IRAs and Roth IRAs. And most people convert their 401ks to their individual IRAs for many, many reasons. And this may be a reason, if this legislation goes through, that you keep it segregated, right? You keep money in a 401k. Maybe that might make sense. We'll have to see what the final law looks like, but it's going to get very, very much more difficult. But that's why we do what we do. So very interesting stuff coming down the pike, potentially, with Roth IRAs. I just gave you a lot of information. Let me see if there's any questions out there on any of that. I have no questions. Good. Okay, let me just check something else here. Okay. Sorry, folks. Again, if you see my eyes darting around, I got 3 screens here, and I'm just moving things around so I can see what I need to see. And I know many of you work in that same kind of situation, so you get it. I also encourage you, especially for times, I think I said it when I was going away, but David McKnight does these podcasts every week, and I listen to all of them. I don't listen every week, but I often catch up. They're only about 20 minutes a piece. But I encourage you to, wherever you listen to podcasts, listen to The Power of Zero, because David also is very, very good at keeping you updated, or keeping us updated on these changes or potential changes. So let's talk about investments in the markets. So the last time we talked was September 14th. So I'm going to start with the week ending September 24th. We had a slightly positive week that week. So September was really rocky, and you know that. The Dow Jones Industrial Average and the S&P 500, so they're the major indices for the U.S. stock markets. They were up just slightly, about 0.5%, 0.62% for the Dow Jones, 0.52 for the S&P 500. Still great numbers for the year, 19.86 and 15.28. Now that is the week ending September 24th. The 10-year Treasury was at 1.45, a little higher than it was the week before. So that is a 10-year U.S. Treasury bond. And the importance of that is, the 10-year Treasury should probably really be at 5% as a good average. And we're at 1.45%. It dipped below 1% a year ago. So September 24th, 2020, it was at 0.67%. They're really, in my opinion, dangerous levels from an economic point of view. Now let's talk about the week ending October 1st, just last week, just at the end of the third quarter. The Dow Jones Industrial Average was down 1.36%, and the S&P 500 was down 2.19%. And NASDAQ, another mostly U.S., I guess it would all be U.S. Index was down 3.19. So the year-to-date numbers came down quite a bit: 13.72, 17.24, and 13.59. So we don't want to see that trend, obviously. So we have to be careful in how we're allocating our funds. We've got to be careful because people get caught up when they do things individually. They look back and they say, well, what's been performing great over the past year or 3 years or 5 years? And they put all their money into that area, and they tend to jump around. And we know from an asset allocation point of view, that is not the way to do things, right? You should have your money allocated in different areas of the markets, not just the S&P 500, not just the Dow Jones, not just the NASDAQ, but all over the globe and all over in different areas, precious metals, real estate, all the things that may not be, especially precious metals may not be, really knocking it out of the park right now, but we know that they'll rebalance and will probably be a top leader at some point. So that's what asset allocation is. So you've got to be careful not to jump into areas in or out that you think are going to be performing or outperforming or underperforming, because that is almost certainly a recipe for disaster, in my opinion. When Money Magazine used to still be a thing, we always used to say that they used to publish something like their top 5 or top 10 funds, and then the next year they were almost always their worst funds. And that is just the cyclical nature of investing, and different things react different ways. So be careful about that, because the 1-year return, for example, of the S&P 500 is 30%. So if you invested all of your money in the S&P 500 in October 1st, 2020, you would have earned 30% over that 1-year period of time, and you would have made a very, very lucky bet, but you don't want to do that. For most people that we work with, it's not about achieving every bit of growth that you can. It's about achieving your goals in the most comfortable way possible. So they're the general markets. Now, we've got some conflicting ideas from our analysts. First Trust is saying for the fourth quarter, historically a strong quarter for stocks, and they show, and I'm going to share this with you, and this could give you some comfort, right? Because September was a very difficult month, and it typically is. Let me share this chart with you, and I'm seeing a question. Gerard, there are proposals. I'm going to just stop and answer Gerard's question. Stand by. Let me bring this down so I'm not looking into the ether here. Goodness gracious. Okay. There are proposals to extend your age to take RMDs beyond age 72. Can you discuss the pitfalls of potentially higher taxation outside of current lower rates? The pitfalls of potential higher taxation outside of current lower rates is you have less money to spend, right? Your partnership with the IRS that everyone has in retirement. You've heard us say this time and time again. Right now, your partnership may be that you maintain 80% of your money, and the IRS takes 20% of this, or the federal government, really. The IRS is just a collection mechanism. So your partnership is really with the federal government. So right now you may be at 80% and they own 20%. And the pitfalls of potential higher taxation outside of the current lower taxes is that could change, right? Suddenly you could be at 40%. That is, the federal government owns 40%. And that's going to get there at some point, folks. As you've heard me say, our studies show that the average middle-class American will be somewhere between the 40 to 45% effective tax rate. We're going to get there at some point where they're going to try all these different things, putting caps on, the people that just earn over $400,000. These are easy, right? Because it's a small number of people relatively. And it's easy for the masses to say, yes, I approve. Yes, go ahead, support that, because we only want to tax the rich. Geez, if you have more than $10 million in your IRA, what are you doing? You should be paying tax on that. Get it out of there. That's too much. But at some point, that's not going to be enough either, right? The studies have shown that. So if we do all these things to avoid conversions or force money out, create a $3.5 million required minimum distribution in 1 year, as I showed you in that example, it's still not going to generate enough tax revenue in those, and the effect is going to come down, and it's going to hit us all in middle class. Just be aware of that. There's, it's just how it works, and that's how it's going to be. But there are the effects and the pitfalls of potential higher taxation. And I do think that the RMD is going to raise to age 75 at some point. So it went from 70.5 to 72, and it went. I do think it's going to be 75. And if we have time, I do have another bit of information from the slot group about that. All right. Now you're not seeing my screen, so let me dismiss that. Good question as always, Gerard. So let me share this. Goodness gracious. Let me share this. This report, this graph from First Trust. So everybody, can you see a graph here in front of you? Thank you, Sharon. Thank you, everyone. All right, so what this is showing is just follow the key here. So the dark blue in each section shows the first quarter return. So first quarter being January through March, second quarter being April through June. Third quarter is what we just finished, right? So July through July, August, September, and then the fourth quarter is the end of the year. And of course, it's color coded. I laugh because my daughter, who's now 15, when she was little, 5 or 6 years old, she used to think that it was color coded, and she wouldn't hear any different about that. And it's just cute. But anyway, color coded. First quarter is dark blue. Second quarter is orange. Third quarter is yellow or gold. And then the fourth quarter is light blue. And then you have down here, you have different spans of time, 1950 to 2020, 2001 to 2020, and 2011 to 2020. And then a year following a presidential election year, which is important for us, obviously, this year. Now you'll see in every one of these circumstances, the fourth quarter numbers have been higher. The third quarter has been lower, right? Fourth quarter has been higher. So this is from First Trust. So they're giving a level of optimism. Listen, it's not all bad. This is a normal cycle. And the fourth quarter is potentially going to be higher. Now, I'm always suspect about the dates that they choose. I haven't gone in and looked at, well, what if they did 2010 to 2020? What if they did 2015 to 2020? But or what if they did 1920 to 2020? And would these numbers still hold up? There's a reason they choose this. First Trust is a money manager. They have active managed funds. They also have ETFs, exchange traded funds. And of course, they want to have you invested in the markets. So this could hold out for sure. We could have a great fourth quarter, or we could continue to struggle. What we don't know are what the economic factors were during these times. And we're going to talk a little bit about that. So we can be optimistic here, but we want to be defensively optimistic, as you've heard me say many times. So back to other analyst reports. Stand by 1 second. I'm going to close that. Riverfront, they write, the third quarter of 2021 began with optimism around strong corporate earnings. You remember that, positive economic momentum, and consumers with cash to spend and places to go. Everybody has this pent up cash and they want to go places. And the negative headlines didn't receive much attention. Then September was the worst month for equities equities or stocks since the spring of 2020. And we know the spring of 2020 was bad. And it served as a stark reminder of what happens when uncertainties intersect with a bull market. So there are certainly a lot of uncertainties. We really don't know what's going to come out of Washington. There's a lot of conflict and loggerheads in Washington. We don't know what's going to happen ultimately, how we're going to come out of this coronavirus. My family, we planned a trip to overseas next year. It was something we've actually been planning for many, many years now, and we decided to hold off on it because we just don't know what it's going to look like. Many people, I'm sure, are doing the same thing. Many people are also holding off on renovations, buying things because the costs are getting so high. So a lot of uncertainty. Slower economic growth is a detour, not a derailment, they say, First Trust, in our view. Headline headwinds impacted third quarter results, but we believe the recovery remains on track. And Riverfront believes utilizing a barbell approach to manage portfolios is useful to navigate volatile markets. Now, Prudential, again, you've heard me talk about this fella, Robert DeLucia. He gives another great report, and he is much more balanced and not as optimistic. So weakness, he writes, both the US and global economies experienced a considerable loss of momentum during the third quarter because of the direct and indirect impact of the raging fourth wave of the COVID-19 pandemic. So whether you agree that COVID itself is in this rage or not, it certainly is raging economically. We have we have supplies that can't be delivered. We have people who can't or are not working. We have positions that can't be filled. We were out to dinner, my wife and I, on Friday night. We started going out, just the two of us on Friday nights. And we've been trying different restaurants, and we went to this little place in near our house that we've been wanting to try. And it was just us. We had to go kind of early because we were dropping our daughter off to work and we had to pick her up. So we had, a 4:45 dinner reservation, kind of the early bird special. We're the only ones in the restaurant, which I wasn't surprised about, but the only person waiting tables was the owner of the restaurant. He said he just can't get help. He has some kitchen help, but he has no support with bus boys, bus people, or wait staff. He's actually paying $20 to $30 an hour for waiters, waitresses, and bus people, and he still can't get people. He was really he heard my daughter works, and he said, "Well, bring her here." But that's common. We're seeing restaurants close, and that's a really direct thing that we see all the time. You hear me talk about restaurants, but that's something we see all the time. But the supply chain is really hurting. I stopped at a coffee shop over the weekend and at Starbucks. I try not to go to Starbucks too often. I like to visit the local coffee shops, but this gave me a really good perspective because they had their shelves were almost empty, and it wasn't because they sold out as far as their pastries and things like that, but they had a sign saying there's a lot of things they can't get. And I think they only had about a third of what they usually have. So that is going to affect revenue. Certainly, if they can't sell the product that they normally sell, it's going to affect revenue. And we're seeing that across the board. If you walk into a grocery store, there's things that you're used to seeing that aren't there, and things are going to cost more. So that is an effect, not just the health effect of COVID, but the economic effect of COVID. DeLucia writes, weakness in retail sales can be attributed to shortages of vital materials and components in the production of consumer durable goods, mostly autos, major appliances, and electronic goods. Spending on consumer services has been even more severely impacted by the pandemic. Retrenchment by consumers is manifested in ongoing weakness in hotel bookings, restaurant attendance, airline travel, and spending for personal care and hygiene services. So here's what I'm talking about. Think about the people I'm using myself as an example. We're not going overseas next year. We've decided that because of COVID. We all know David McKnight, who I work closely with and has become a good friend. David invited me to visit him in January in Puerto Rico, where he lives, and I'm not sure if I'm going to go because of COVID and COVID restrictions and all the things going. I can't afford to get locked down in Puerto Rico. We just don't know. Now I might go, but I don't know. But here's your weaknesses in hotel bookings, restaurant attendance, airline travel. Normally I would be there. I would have already planned my time. I would have probably taken my family with me, but if I go, I'm probably going to go just myself. So multiply this by millions, and this is part of the effect that we have. So DeLucia is downgrading his forecast for the GDP growth from 6.5% to 4%. He also writes the economy will remain hostage to COVID-19 until conditions begin to improve. While it is unlikely that the high level of infections and hospitalizations will derail the expansion, the future path of the pandemic will clearly influence the growth rates in spending, output, and employment. It's interesting, with some of the information I get as a school board member, I'm seeing that we got some information from Doylestown Hospital and CHOP that certainly CHOP, that there was a concern just a few weeks ago, or certainly maybe a month and a half ago, that the beds are going to be full of kids sick with COVID. And what they're seeing, they're telling us, is they're sick with other things. They're really heavily sick with RSV. That I think that's their it's a typical virus that almost every kid gets, but because not many got sick last year and their defenses are down. I'm just telling you what the doctor said, that they're getting it much. It's a much more severe case of it. It's demanding a hospital stay. So again, it's not just COVID, it's everything that's affected by COVID. So it's going to be really interesting, and that to see how this plays out. And that again is just the uncertainty of it. So it's 10:41. We've talked about a lot. Don't forget that we have our classes coming up. We start the 19th. Let me just double check that. Yep, 19th, the 20th, the 26th, the 27th, November 2nd, and November 3rd. These are 3 nights for 2 hours each. In a live class, we do 2 nights, 3 hours each, but 3 hours is just a long time to be sitting in your chair watching a webinar. And these will be live. They'll be recorded, but they probably won't be released for recording on the website. So if you're interested in it, you should watch it live. And that's all I have for today, folks. Remember, as you log off, if you need an opportunity to see us, you can schedule time for that. If you can't find any time on the calendar that works for you, let us know and we'll make something fit. If you're already a client and you have something scheduled, a financial planning meeting in particular, please keep that meeting and don't change it, because we're doing a lot of work in the background to prepare for that. But of course, if you're a client and you need to see me about anything else, call us, email us, or schedule time in the calendar. If you can't, the first available times we have are next week, but if you can't wait until next week, that's okay. Reach out to us. We're here for you. And let me just check to see if there's any other questions, and I don't see any. So I want you, it's good to see you all. I hope you have a great week, and we'll see you next Tuesday. Thank you. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.